Hi everyone, this is Ben Ryan of Hedgeye's macro team, and today we want to give you an earnings season update. Really now, Q3 earnings season is now really, we're reaching the conclusion, and we want to just kind of give you the big takeaways. We'll start doing this probably twice a quarter, but really like the message across the board, across indices in the US is really just one of growth accelerating with I think if you look at the actual internals from a comps perspective, second derivative deceleration, but still very positive, particularly in the technology sector, and that's something we'll really get into. But I mean, a lot of these earnings type of metrics, you have actually information technology, that sector within some of these indices that's really driving a lot of the strength. And I think that if you start to look out maybe Q1 of 2018 into Q2, you start to see this difficult comps picture start to develop, and that's on the back of what's been very positive revisions, very optimistic revisions, and of course that's due to a result of earnings just crushing expectations for the first 3 quarters of this year. But it's really been very positive, growth accelerating, and that's reflected in corporate profits. We have some slides prepared for you, so hopefully it'll be something you can get through quickly and kind of get the key takeaways that we want you to get. So let's turn to the first slide. So this is really just a scoreboard of Q3 earnings season. So here we show the S&P and NASDAQ 100, but you can see the earnings growth came in almost finished. So you got 474 of 500 companies reported. Earnings growth has come in for the S&P 500 in aggregate at 7%. The one thing we'll point you to is just that information technology sector. You have 60 of 68 companies that have reported, so you're basically toward the end there, and earnings growth is up 25%. So companies have really, the earnings growth trajectory has been very steep. And then if you go to the NASDAQ, because there's a more heavy weighting to these growth and tech type of companies in the NASDAQ, the aggregate number is up 21% year over year. That's 96 of the 102 companies have reported. And then within the information technology umbrella of the NASDAQ 100, you could see the 36 of 40 have reported. Earnings growth is up 31%. So just, again, very steep trajectory of earnings growth. And that's clearly been very positive for the market, and specifically those stocks that encompass the more large cap growth, large cap tech type of exposures. Next slide here. Pulling back the curtain, what do you see here from an earnings growth perspective? You see that a lot of these very good comps this year, so for example, in Q1 of 2017, this up 14.5% year over year, like the one trend and the one factor that's really hard to buck is this comps effect, so this base effect. When you're trying to project earnings growth and you're going on top of, while the economy accelerating, growth accelerating, you're going on top of these very easy comps, that's when you start to get these big numbers, these double-digit growth numbers. But I think the main takeaway here, and what you can see is there's been a deceleration from Q1 of 2017 was the peak growth rate to Q2 to Q3, and so that's been very telegraphed. That's something that's come up in our macro themes presentations. We've talked about it, and I think it's when you actually look to Q1 of 2018. I mean, that's a wall of comps that companies are going to have to go against, and I think you also have this kind of behavioral and psychological trend at play where people are really kind of coming around to these growth exposures, long market exposures, and eventually that becomes very one-sided and dangerous. But for now, these companies will not report until April of 2018. So we have a lot of time, a lot of wood to chop between now and then. Next slide here. Again, one thing that is an important call out we feel is this. If you actually look at the comps for these information technology companies, Q1, Q2, Q3 of 2017, remember that those are on the back of negative growth rates. So if you go back to Q1 of 2016, Q2 of 2016, even information technology companies actually comped down. So many of those very positive growth numbers, the steep growth trajectory numbers, have come on the back of easier comps. That's no longer the case starting next year. So it's definitely something we'll look. And again, just looking backward at how positive earnings has been as a catalyst for these technology companies. So the next slide shows the earnings surprise factor. So really what we're looking at is how much did sales and earnings beat relative to where expectations were. And you can see in Q3 2017 so far for these companies, I mean, tech companies have beat earnings by 11.3%. So absolutely crushed earnings. So there are estimates from the sell side, and then you also have those estimates. The buy side weighs in, and that's what actually moves the market. So anyone that was short these kind of names on the potential for bad earnings and multiple compression obviously got crushed, short squeeze, and the stocks tend to go up. And that's been a huge market catalyst this year. I think XLK, the technology ETF of the S&P 500, is up over 30%. So it's been very positive. The next slide. Again, this is just kind of showing you relative to the rest of the market. So really what you have is, in most sectors, companies have actually beat by less than average beat rates. And it's been completely the opposite in technology, and that's, again, why it's been such a catalyst for the stocks. Next slide, you can see this again just shows you the beat rates across Q1, 2, and 3. So again, like companies, there is an expectation for where earnings are going to come in. Oftentimes, companies will manage their financial statements to ultimately beat those expectations because they don't want any kind of big move in the stock. And really, what you've seen again is this is the surprise factor, the market catalyst, is companies have beat on average through Q1, Q2, and Q3 on average by 8.3%. That's more than double the average beat rate of the last 5 years. And the cycle beat rate is right around the same as the last 5 years. So again, a positive catalyst. And then the internals, one kind of nuance to this concept of earnings beating estimates on the next slide is you can see that companies have beat estimates on the back of intra-quarter revisions that were actually very muted. So the typical trend or typical course of kind of chain of events is that earnings expectations for out quarters are too high. Once it gets closer to earnings season, companies take down expectations, and then they end up beating those expectations. And what you can see really is that these positive beat rates came on muted revisions. So earnings expectations weren't taken down and then beat by a wide margin. They actually were taken down by less than average, and then companies still beat those expectations. So the trend there is that it's been very, very positive. These earnings events have been catalysts. They've been market catalysts. The next slide, you can see just how one-sided it is with information technology. So really what's happened here, and what this has done, these earnings revisions, is, again, companies report very positive earnings. Sell side takes up their estimates for out quarter. So this is looking at the next 12-month EPS estimate. And you can see that the reason that the market multiples, particularly in tech, has actually been muted. So you have tech that's up 30%, but the multiple expansion has been very little. And that's because of this just very steep upward revision trend in technology earnings, right? So if you have that denominator that's an earnings expectation, price is up 30%, but if you really have an earnings expectation trajectory that actually keeps up with that, you end up with this muted market multiple. And you can kind of see that on the last slide that we have, where the multiple's gone nowhere. And we think that this doesn't matter when the setup for the economy is a quad one type of setup, when most things in equities go up, particularly tech tends to outperform. But when you actually take a step back and look at that comps type of picture that you're coming up against, it could become a real catalyst the other way when it matters, because ultimately consensus all ends up on one side. And even after a big move and after earnings revisions have been, after the tech has outperformed and analysts take up their expectations, ultimately you have sky-high expectations behind a market that's already done really well on a trailing sense. So that becomes dangerous, and that's where you can kind of get these idiosyncratic kind of asymmetric type of setups if something were to change from a growth and inflation perspective. But again, so that should be the wrap up for Q3 earnings. Hopefully that was easily digestible, and we'll keep you posted. We'll try to do these updates twice a quarter, and hopefully this is helpful. Thanks.